A word to the wise, those in the market for a mortgage. I have knowledge that will change your view about credit ratings, so don't miss it. You surely know that having a high credit score is a great achievement. However, a new federal law may increase your mortgage costs by flipping that idea. Intrigued? Let's start with a fascinating summary. Before that, let me remind you to hit that subscribe button and turn on notifications so you never miss a video from us. Imagine you've worked hard to keep your credit score high to get the best mortgage rates. Not yet. CFPB rules may complicate your mortgage arrangements. New federal restrictions on May 1st may increase or decrease the price of your dream home. Since you're paying attention, let's go over the new details. Why having good credit could cost you more on a home mortgage. Credit scores have always influenced loan choices. High credit borrowers get better loan terms. New rules require lenders to look beyond credit scores. Discuss earnings, debt-to-income ratio, and work experience. From one man to full cast is a big change. You may be wondering what this has to do with your finances and why it even matters. Well, I'm about to explain it, so hold on to your hats. Lender's evaluation becomes more complex and time-consuming when these additional aspects must be taken into account. More fees for the lenders, you guessed it. But now comes the tricky part. When financial institutions incur higher costs, they often look for ways to recoup those costs from their customers. Sure enough, the debtors. No one wants to be met with the unwelcome prospect of rising interest rates or additional fees, just as they're about to embark on the thrilling road toward homeownership. Don't worry, friends. This new restriction may appear like it may hinder your mortgage application, but there is a silver side. This legislation ensures fair lending by leveling the playing field. Lenders can increase loan eligibility by looking beyond credit scores at other financial responsibility indicators. Let everyone shine in their own way. What does this signify for potential homeowners? It's mixed. This rule tries to make lending more inclusive by reducing the power of strong credit scores. Fair lending and effective borrower evaluation require a balance. Exciting, right? Stay informed and prepared for this new rule. Compare lenders, offers, and possibilities to get the greatest bargain on your dream home. You must negotiate the ever-changing mortgage landscape. If you relied on your credit score, don't worry. This rule may disrupt things, but it's meant to make the mortgage market more fair and inclusive. Be aware, financially wise, and alert. Why is this happening? Who knows what goes on behind closed doors? Allow me to take you on a journey to learn more about the history of the loan level price adjustments, LLPAs, and why they have recently changed. Now is the time to kick back, relax, and let the complexities of the mortgage industry delight you. Risk analysis, market dynamics, all intertwine to form a complex tapestry that is today's mortgage landscape. Recent LLPA changes reflect an effort to adapt to the dynamic nature of the housing market and refine the mortgage lending procedure. These changes aim to better reflect each borrower's risk. Fees may not have always represented default risk or other concerns. Higher credit scoring borrowers paid lesser fees, creating unfairness. These fees misrepresented borrowers' risk. Friends, we want equality. Recalibrating the LLPAs will better represent borrowers' particular situations to better match loan costs to borrower risks. But why would borrowers with better credit scores end up paying more in fees? Good observation. A borrower's risk can't be assessed only by their credit score. They are necessary, but not sufficient. The revised regulations consider this and add risk indicators like down payment size and home type. Lenders can more accurately assess the risk of default and adjust the fees by taking into account a wider range of factors. It's like looking through the different faces of a diamond to see its true luster. Lenders can make better informed decisions about fees and interest rates by taking into account a broader range of indicators when calculating the risk of default. The effect is similar to looking through a diamond's many facets to see its genuine radiance. The current adjustments are not random, it must be stressed. They are the result of extensive research and constant monitoring of the housing finance sector. Monitoring market circumstances, economic trends, and lender input allows regulatory bodies like Fannie Mae and Freddie Mac to make choices that are in the best interests of borrowers and the housing industry as a whole. Thus, LLPA modifications may seem like a surprise in the mortgage story, but they serve a more important purpose. By implementing a fairer, more nuanced pricing structure that accounts for more risk considerations, they hope to strengthen and sustain the mortgage lending ecosystem. Some borrowers will pay more, some less. However, the goal is to find a balance between accurately assessing risk and providing mortgages at affordable rates to borrowers of all financial backgrounds. Who does it impact? Borrowers get priority. This guideline may affect your mortgage application, whether you're a first-time buyer or a veteran homeowner. Even with good credit, loan-level price adjustments, LLPAs, may increase upfront costs. However, people with bad credit can get discounts and lower rates. Borrowers' mortgage journeys are emotional roller coasters. Still more, lending institutions are key characters. The new rule gives lenders extra parameters to evaluate borrowers. Lenders may need to adapt their underwriting techniques, apply new technology, and verify for regulation compliance. Larger banks may adapt to the new rules more easily. Smaller lenders or those with less skilled underwriting may find these changes harder to adopt. The ever-changing mortgage market will test adaptability. However, let's not forget the government and policymakers. The CFPB and other federal agencies create and enforce these regulations. They want to promote responsible lending, risk analysis, and housing. They write mortgage sector laws, setting the tone. Finally, this story is framed by the housing market. This new policy seeks to balance market stability with broad mortgage eligibility. Refining risk assessment and improving evaluation reduces the danger of defaults and financial stress that could damage the market. Doing this for your home is like maintaining natural peace. How will it work? Certainly, here is a clear and comprehensive explanation of the new federal rule governing mortgages. Mortgage lenders must evaluate candidates beyond credit scores under the new rule. Salary, debt-to-income ratio, employment stability, etc. Loan-level price adjustments, LLPAs, may cost borrowers upfront. We can better reflect borrower risk in our fees by modifying LLPAs. Thus, lower credit scores may result in lower interest rates, while higher scores may result in higher rates. The guideline requires lenders to consider more variables when establishing a borrower's creditworthiness to promote fair lending. The program helps those with bad credit but good financial habits. The bill might raise mortgage rates, hurting the economy. Lenders may have to spend more to meet the new rules, and borrowers may pay more in interest or other penalties. Lender and mortgage agreement determine the effect. The rule requires lenders to consider more variables in lending decisions to stabilize the mortgage market. To reduce defaults and financial stress, better loan selection and risk assessment are needed. To discover how the new rule may affect their mortgage, borrowers should stay informed, research their options, and talk with their lenders. Education will help borrowers adjust to the shifting mortgage market. Is this a good thing? Should we support this mortgage law? I wish I could answer you simply, my friend. Let's dive into this issue and examine the various perspectives on this rule in an engaging way. This mortgage law is a positive change. It considers factors other than credit scores to make financing more accessible and fair. If they have good financial indicators, low credit borrowers can get mortgages. It's like opening doors to the excluded. Story twist: this rule may increase mortgage costs for some borrowers. Excellent credit holders may struggle to pay higher interest rates or fees upfront. Some may call this good credit score bad news. It's hard to accept justice. Ultimately, this guideline's usefulness is subjective. Some may pay more for better mortgages and fairer lending processes. The new pricing structure may lower the value of a high credit score. No worries, friends. The rule's goal is to boost mortgage market diversity and fair lending, so don't worry. By considering more characteristics, lenders want to help underserved borrowers. Thus, you should educate yourself, take the initiative, and consider all your options before becoming a homeowner. Before making a mortgage decision, consider how the new rule might affect your situation. Remember that high credit scores still have numerous benefits, and that the rule may complicate things, but it strives to make evaluations more fair and accurate. Keep going, adapt, and believe you'll get there. Thanks for watching, and please like and subscribe for more mortgage business news. Until next time, happy house hunting, my savvy viewers.